got Luca Silipo, who's Chief Economist for the Asia-Pacific region at Natixis, who joins us now on the show from Hong Kong. Lucas, to begin with, what's your view on the China PMI data, and also how do you believe this is going to impact Asian markets?
Well, on the one hand, it's very reassuring that China is continuing this controlled slowdown. And, the two sectors that are slowing down the most, so real estate and steel, heavy industry, are the ones that were deemed to be in overeating by the Chinese authorities. So this slowdown is very much policy oriented. On the other hand, if you look at the breakdown, you start seeing some confirmed weakness on exports, and this is obviously something that comes with particular worries over the outlook for the whole Asian economies.
Right, for oil supporting nations, the rising oil prices are being a big concern right now. What's the sense on where oil prices can head for FY13 and how that may impact geopolitical situations across the region?
Europe is not going anywhere until now, and the U.S. economy recovery, although on a very solid base, is going probably to take still some time to take pace. So the global environment indicates that oil probably should be in less demand, and so price should react negatively. However, there are geopolitical tension always, as you just mentioned. Obviously, the closest one is Iran. What is going to happen in Iran is obviously crucial for the outlook in the price of oil. I'm not a politician, so I don't know how to forecast this. I can say that structurally, oil price tensions should dissipate in the next few months, barred of course a major intervention, forced intervention in Iran.
Right, Luca. Also, how are you viewing Asian currencies, and which currency would you be betting on?
Well, if it's true, as I said before, that international trade is moderating everywhere, and especially in Asia, then this means obviously less capital inflows in Asia. I mean, capital related to trade, but also capital related to investment that try to take profits from a significant growth outperformance. If international trade moderates, this put in question the whole model of development and growth of Asian countries that is mostly based on trade, especially obviously for some countries more than the others. And so generally we should see a weakening of Asian currencies. This will affect also currencies of countries that are not too much implicated in trade. And obviously this is the case of Indian rupee, but they are part of a system, and probably the market would not make the difference, and would not make the difference with respect to other currency, and would continue to sell off this currency. So we are pretty negative for currencies in Asia due to weakening of trade, also for currencies whose country is not too dependent on trade.
How likely will India achieve its 7.6% GDP growth target for FY13, and also meet its much talked about fiscal deficit target of 5.1% of GDP?
In our opinion, it's very unlikely. We see growth of the Indian economy more in the region of 6.5, 6.8. As I said, regional weakness, probably further weakness, as I said, in the month ahead, but also in the quarter ahead in some country, would undermine this objective of India. Plus, India have its own structural issues. Sorry to say, but I'm personally sorry, because I was convinced that after the last election, with such a big mandate, the government could do more in terms of industrial policy for India, but very little has been done on this item, and so the Indian economy is not yet able to express growth at its full capacity, and this is the reason why we're seeing it underperforming the targets of 7.5%.